Good afternoon and welcome to the Meridian Interim results for the period ending December 2015. Seems a little bit unusual to say that when the results have actually been out for 4.5 hours, but anyway, here we go. It's been another solid performance for the company, with our main profit measure EBITDAF up 2% on the previous corresponding period at $332 million. This reflected a higher energy margin both in New Zealand and Australia. In New Zealand, generation was down marginally. Retail sales volumes were up in most segments, with overall retail sales volumes up just under 6% and the average price achieved up by 3%, reflecting price increases and better customer segmentation. Net profit after tax at $104 million was down $13 million or 11%, largely as a result of large fair value movements, and Paul can go into that in a little bit more detail, very arcane accounting. Underlying net profit after tax, which backs out fair value adjustments and one-offs, was up $7 million or 6% on the previous year. Again, Paul can take you through those numbers in his presentation. With operating cash flow remaining strong at $207 million for the half and stay-in-business CapEx remaining within forecast, an interim dividend of 5.1 cents per share has been declared. This is up 6% on the interim for the previous corresponding period and is 22% higher than the initial interim dividend declared post-listing for the period to 31st of December 2013. Given the company has continued to trade strongly and there have been no adverse events or other calls on capital, the board has decided to continue the announced capital management program. Following the initial payment of a special dividend, we consulted a range of shareholders as to their views on the best manner of undertaking a capital management plan. As you would expect, there are diverse and quite strongly held views as to whether special dividends or share buybacks are the most efficient. Having considered all these views and their obligation to consider fairness to the company and all shareholders, the directors have resolved to pay a special dividend of 2.4 cents per share, or $62.5 million in total, bringing the aggregate amount applied to the capital management program so far to $125 million. The special dividend will not have any imputation credits attached to it. Other highlights in the 6 months included the continued growth in PowerShop customers in Australia and the agreement with npower, one of the big 6 retailers in the UK, to franchise the PowerShop operating system and brand. Overall demand growth was modest in the 6 months at 0.2% uplift, and the 12 months to 31 December 2015 saw a 1.4% increase. It was pleasing to note that the growth in the primary sector, agriculture, forestry and fishing, saw pleasing growth. Agriculture being a key segment for Meridian. On the supply side, we have seen 600 megawatts of thermal capacity withdrawn from the market and significant speculation as to the slated Rankine unit closures in 2018. We cannot add any further context to this issue other than to say we have a number of potential options to cover our position, some of which are with third parties and others involve us looking at internal options. One way or another, we remain confident that that the market will solve the wider industry issues, and the behaviour of forward prices on the ASX would suggest that this is the current view of the market as a whole. On the regulatory front, we are keenly awaiting the Electricity Authority's second issues paper before the 31st of March, which should clearly indicate the preferred option it would like to adopt following its transmission pricing review. The outcome has potentially positive implications for Meridian, but is also of critical importance to our single biggest customer, New Zealand aluminium smelters, with a potentially significant reduction in its cost base. It was a relief to see the long-standing review of the renewable energy target in Australia reach a political solution in June last year. However, since then, and despite a 41% increase in the price of large-scale generation certificates in the 6 months to the 31st of December, no new projects have been announced other than those that get extra federal subsidies, despite all-up current prices per megawatt being above the cost at which a number of large-scale wind projects would be economic. This reflects ongoing nervousness as to the longevity of the scheme, given its political history, and a result of banks' reluctance to finance projects without long-term power purchase agreements, which aren't exactly thick on the ground. PowerShop launched in New South Wales in February 2015, and customer numbers in both New South Wales and Victoria continue to grow in a highly competitive market. As you can see from the graph, the price of aluminium in US dollars on the London Metal Exchange declined over the period by 10%. Since December, prices have firmed slightly, but there has been little further relief from the New Zealand US dollar cross rate, which has, despite predictions to the contrary, held up in the 65 to 68 cent range for most of the reporting period. The latest aluminium industry forecasts suggest that ramp-ups and restarts around the world are going to drive global production higher, despite plant curtailments in both the US and China. From all of this, it is difficult to see a markedly improved trading position for our largest customer over the immediate future. The ultimate owners of the smelter, Rio Tinto and Sumitomo Chemical Company, reviewed their option to issue a termination notice under our contract in August and decided not to. As part of the negotiations around that decision, Meridian offered to recontract with respect to the 172 megawatts of load that would otherwise be carved out of the contract on 1 January 2017. And achieved a higher price for this tranche from the state. However, as the market is aware, NZAS retains termination options and can provide us with a termination notice on or after the 1st of January 2017. This will undoubtedly be an important year for the smelter, as it again considers its options, with the added variable of the Electricity Authority's transmission pricing review decision being made clear this year. Meridian and NZAS have been on the same side of this debate, and there is definite inequity and a drag on international competitiveness for a single plant business based in Bluff to be asked to pay for transmission upgrade costs which are for the benefit of North Island consumers. Hopefully, we will see a movement to a beneficiary pay system which is far more equitable and economically efficient. The size of any savings to the plant are, in my opinion, going to feature strongly in the smelter owner's review of the plant's future. For the period, New Zealand generation was marginally lower at 6,858 gigawatt hours. The new Mill Creek wind farm achieved generation volumes ahead of its business case, and stay-in-business capex remains well within budgeted levels. The average price achieved in the spot market for generation at $57 per megawatt hour was down on the same period last year, but on the other side of the equation, the average price paid to supply customers was also 12% lower. One of the high points for the period has been Meridian Retail performance. Corporate and industrial sales volumes were up 4%, and the residential and small and medium business customer segment some 6%, despite a small decline in the number of connection points or ICPs. Average prices also moved up, 2% in the residential and small and medium business segments and 4% in corporate and industrial. This was a result of price increases in some networks as we moved energy prices for the first time in over 3 years. Further improvement was limited by some operating cost growth to counter strong competitor activity. And Paul will talk a little bit about that in his presentation. A significant effort continues to go into improving the customer experience, and the Energy Centre was the winner of the 2015 CRM Contact Centre Award for Commercial and Business Support Services in September. Meridian will continue to market itself strongly to the small and medium business sector and has recently launched a partnership with Xero to allow Meridian customers to directly download their electricity bill into Xero. I'll now hand over to Paul.
Thanks. Mark's given you a good rundown of the key highlights for this half and the environment we're operating in. I'm now going to give you a bit more detail in a couple of areas and then go through how the numbers break down. Firstly, I'm going to cover the agreement with npower, which will see the PowerShop brand and platform launched in the UK. This is an attractive value accretive opportunity with a known boundary to downside risk, but we're keen not to get everyone overexcited on this. It's not the next Uber or Airbnb, and there is a fair amount of hard work ahead of us. However, given that we've already successfully launched into Australia and have a well-motivated partner in npower, we are confident in the team's ability to execute and deliver the PowerShop experience to the British public, and I'm certainly looking forward to selling PowerShop to my own family members over there. Before going through the detailed financials, I'd like to just take you through the various elements of the dividend payment. As Mark mentioned, the ordinary dividend is up 6% on last year. This reflects both the lift in profit we've seen and the gradual movement toward a 90% payout of free cash flow over the next few years. The level of imputation credits attached at 85% is above that we indicated at listing. We now believe that this level is sustainable. With the next tranche of the capital management programme paid as a special dividend, the total interim dividend for the half is 7.54 cents per share. Turning to the numbers, this page shows the half-on-half change for each of the key lines. So first of all, the big one for us, energy margin, up 6% on prior year through a combination of the growth in retail sales volumes of just under 6%, 2.6% growth in average retail sales price. Then we've got the growth in PowerShop Australia's customer base and the firming in LGC and base energy prices in Australia. You can then see an offsetting item being the reduction in other revenue over last year of $8 million. Now, this included a one-off insurance receipt last year of $5 million relating to the Christchurch earthquake. Additionally, the sale of ARC and of surplus farms last year has reduced other external income. And there's a summary on page 29 of the appendices to this presentation that shows all of that impact. As we've previously signalled, transmission costs have risen again, highlighting why we are so keen to see the publication of the TPM decision. I'll cover operating costs a little later, but we have seen three big impacts here. One, cost associated with growth, principally overseas. Second, some reclassifications and timing differences relating mainly to metering costs and the previous treatment of these whilst we owned ARC. And some additional sales and marketing costs associated with a high level of retail competition we're facing. All this translates to a 2% rise in EBITDAF, and if we exclude the impact of one-off insurance receipts, this increases to a 4% gain over last year. Operating cash flow did drop back a touch. Now, this was mainly on the growth in working capital in Australia, partly associated with the PowerShop, but principally with the higher price of LGCs, which settle in January of every year and therefore reach their peak in December. You can see there also how the completion of new builds has translated into lower capital expenditure, and all of this has allowed the lift in declared dividend that I talked to you about earlier. I think the next page is just all the stuff I've mentioned in written form, so you can all look at that later, and I'll move on to operating costs. The top right shows a graph of where our operating costs have been spent on a segmental basis, and you can see that the wholesale and corporate segments of our business were largely static, despite cost pressure from the maintenance of a new wind farm, which was pleasing. We did see increases in our international segment, supporting growth in margin, which is a net positive to the bottom line. In our retail segment, we saw around $1 million of timing difference on brand and metering spend, and $1.4 million of costs that were previously classified within energy margin, which have been reclassified into operating expenses because we no longer own ARC, and therefore they're not a direct cost, but a cost we suffer externally. There was, however, even with these timing differences, some underlying increase in sales and marketing spend really to counter the competitive pressure that we felt and to support our increase in overall price. And if you look at that segment as a whole, you'll see in the segmental analysis in the accounts that profitability is improved by 5 million half on half. We expect second half cost growth over last year to be largely limited to the growth initiatives, so no repeat of the other parts, and we're working hard to complete system improvements that should yield retail efficiency improvements. We're very confident of staying within our average $65 million envelope for stay-in-business capital expenditure, and our forward asset management plans continue to be completely consistent with that envelope. Just moving to the stuff below EBITDAF, there are a couple of large non-cash changes in fair value movements which are worth noting. We saw no repeat of last year's significant downward movement in interest rate curves, which had a negative impact last year, but we did see a movement in forward electricity market prices, particularly in Australia, that negatively impacted the fair value of our quite large hedge book. The biggest part of this relates to LGCs. So in June last year, the LGC scheme was reconfirmed. Now at that stage, LGCs rose from around $25 to mid-50s pricing. At the time, Tony Abbott was still in power and making a lot of negative noises about the future of the scheme. Meridian decided to lock in prices that ensured we achieved more than our cost of capital on our wind farms there and covered forward a substantial portion of our LGC risk at pricing of between $57 and $69 across a 3-year period to the end of calendar year 18. Subsequently, with the change in federal leadership in September, the prices of LGCs lifted further, reaching a peak at the end of December. This means that these forward sales needed to be marked to market and a fair value loss booked. This is not a cash loss, rather the opportunity cost of not standing unhedged in the market, although who knows where prices will go over the next 3 years. With hindsight, this might look a little unfortunate, but I'm certainly not going to apologise for not playing fast and loose with risks we can't control. Excluding non-cash fair value movements and the impact of last year's asset sales, the improvement in EBITDAF and a reduction in interest costs lifted underlying NPAT by 6%. Excluding the insurance receipts last year, tax affected, this would equate to a 10% lift. I'll just now pass back to Mark, who'll make some concluding remarks and then move on to questions.
Thank you, Paul. Before offering a few concluding remarks, I'd like to advise what all of you already know, that Meridian is considering a bond offer to retail and institutional investors of up to $150 million. It is expected that details of the offer will be made available in early March, and the ANZ Bank has been appointed as lead manager, and the issue will be co-managed by First NZ Capital and Foresight Bar. You'll note that the slide contains no guidance as to the full year result. We made the statement on listing that following the expiry of our prospectus forecasts, we would be not putting forecasts out into the market, as our exposure to hydrology conditions provided the potential for too high a degree of volatility. We maintain that view, but will continue to monitor analysts' consensus forecasts to ensure that it is not materially out of line with our own views. The availability of our monthly operating reports allows analysts and those shareholders who have the time the ability to monitor performance on key metrics. Our focus, both strategically and operationally, has not changed. At an operational level, we are focused on producing improving cash flows for shareholders through improved asset management and a focus on higher yielding market segments and the attraction and retention of customers through superior customer service. At a strategic level, we continue to support the Electricity Authority's review of the transmission pricing methodology and the adoption of options that are more equitable and economically efficient. I remain very hopeful that the way forward on this long-running issue will be determined well before our full results announcement in August. We will also progress all Meridian's options to provide dry year cover post-2018 should we experience a period of dry conditions in our catchments at any point in the future. As previously noted, a lot has been said about Genesis' consideration of the future of the Huntly-Rankine units. Genesis will make this decision based on its own needs and discussions with other market participants, including Meridian. But as previously noted, Meridian has other options to potentially cover its position. The way forward will probably become clearer over the next 6 months. While it has been pleasing to see the margins in the retail part of the business improve, we need to continue to close the gap with our competitors. And finally, in a market that presents limited growth opportunities, the Power Shop initiative with npower in the UK provides a unique avenue for growth, with opportunities of scale if the implementation is successful. It is early days in the development process, but work is progressing well at this stage. With that, I will open the floor up to questions. We'll take questions first from those that are actually present, and as we have people listening, can you all use a microphone, please? Andrew.
Afternoon, guys. Couple of questions from me. First of all, I guess just on the Australian situation and sort of the renewable energy certificate prices, we've seen those ramp up.
Yep.
In the past, you've talked about not having any particular development options. I don't know if you've done any further work over the last 6 months or so in terms of trying to develop further options, given things are looking, I guess, a little bit more encouraging than they were.
Yeah, they are looking a little bit more encouraging, but I mean, it is interesting that pricing is still looking very appealing, but nobody is doing anything, and it comes down to there is just no power purchase agreements available in the market. The most that anybody is doing is around about 5 years, and 5 years just do not make projects bankable. So, I mean, something's going to have to give, Andrew. Don't know exactly what it is, but as things currently stand, I mean, we are just not seeing projects progress. As far as us developing other options for Australia, we haven't done anything over the last 6 months, but from a strategic point of view, that is something that we're most certainly open to. We wouldn't be developing for the same reasons that I've just set out now at this point, but something's going to have to change. Otherwise, they just haven't got a hope of meeting their target.
Okay, and the second question was just around the dividend, and I think we've had a bit of a discussion about this in terms of special dividends and buybacks and the like. I guess, given that you've gone with special dividends this time around, what would need to change from your perspective, or I guess from the board's perspective, to actually start paying out in buybacks as opposed to a special dividend?
I think you'd have to see a significant differential between the current share price and the board's assessment of value at that time. And at the moment, that differential is not significant. I mean, the board's very aware of its obligations to make sure it's fair to all shareholders and has to take a balanced view.
Okay, and just a couple of more quick questions. The npower agreement, are you able to give us a little bit of more clarity, I guess, on the timing of when we might sort of see something come through? Or
That's a little bit hard because npower are clearly very sensitive about publication of any time frame in terms of its competitive position in the UK. But we did get asked this morning, we're going to see you being flush with funds from the UK inside the next couple of years. I mean, the answer is we will cover our costs. We get a cost recovery fee, and then we're going to get a variable on the number of customers. So I think we need to wait a couple of years to see the product get developed and then its acceptance in the marketplace. But what I do like about it, Andrew, I mean, we aren't exposed to country risk, as Paul said. We understand the downside. If we fall flat on our face, we know that what that looks like. It's not, nobody wants to fall flat on their face, but it's not bad. And the UK is a very large market, and npower has other subsidiaries in Holland and in Germany that are watching developments. So it's something a little bit smaller than, a little bit bigger, should I say, than 4 million people in New Zealand.
And just my last question was just around retail. I mean, you just finished off the presentation commenting how you'd like to see, I guess, the gap between yourselves and the rest of the market close up a bit. Does that imply more price increases coming through, or is it more a case of standing still and let everyone come back to you?
There's a bit of that going on. I mean, it's a bit unfortunate that I was just looking at the graphs that the guys were doing off the back of the interims, and all of those lines seem to be converging. And yes, we're going up, but everyone else, unfortunately, seems to be coming down to meet us. So I think we just have to think carefully about what we can do. Certainly, we have to continue with the segmental targeting, which has had some positive impact. But whether the market can stand price increases is debatable. I mean, particularly in some of our segments, such as the agricultural area, where there's a lot of pain.
Thanks.
Any other questions here in Wellington?
Just carrying on with retail then. One of the other things we're seeing is pressure on acquisition, retention, appearing at the cost line. What kind of experience have you had, and comment could you make about this year, and what should we think about going forward?
We've seen some inflation of those acquisition costs. I mean, you've seen our offers are transparent, they're out in the market. They've not been ramped up as heavily as others. We haven't capitalised any of those costs, by the way. The other area which has been impacted is just the requirement to have warm bodies available to do the rounds. The personal approach does pay some benefits. So we've seen increases both in the salary line, in the sort of promotional line, presents to new customers, and in the margin line. But so far we are keeping ahead of that increase. I would hope it could continue.
And it's cost us, obviously, to ramp up a little bit in terms of targeting, small, medium business. I mean, so that has involved people. So, I mean, the retail segment was up, which was pleasing, by $5 million. I mean, yes, we've had some cost pressure. It is competitive. If we could get those costs down a bit, I mean, we could see some further improvement.
Will the transition to AMI meters also put some cost pressure into the business?
Well, hopefully we will have all the metering done by the first quarter of 2017. And, I mean, while there will be, broadly neutral?
It's broadly neutral. You've got some improvements in some of the rates. You've got some of those legacy lower-priced rentals rolling off. You've got a lot of event services which become remote, which is positive, and of course the read costs drop away. And then you've got the pressure of reads on the very few residual meters that remain. Now,
we just looked
that's
at this.
going to need to be dealt with as well.
We just looked at this the other day.
It's sort of
Neville, I mean, it is a bit of a moving feast, but it looks like it's going to be around about neutral. But obviously the benefits of having remote reads in terms of efficiency, making sure customers' bills are correct, avoiding calls to call centres, etc., credits going through, all of that sort of stuff is significant. And what it will do in terms of being able to target more tariffs that are based on time of use, which is just impossible for us to do at the moment, as you know.
There's been a good reduction just off the back of it already in some of the sort of bill error rates, first bill reading issues, and all those sort of things that become churn triggers for customers. So we don't sort of count that in there, but we see it as being positive from the sort of hygiene perspective.
Great, thank you.
Any other questions here in Wellington? No, okay, I think we can hand back to the ether. I mean, are there any questions from people who are attending remotely?
Last time we did this, there was an issue with connectivity, so...
I can't believe Grant Swanepoel hasn't asked a question. They can't be... Is anybody out there? Thought so. Nobody's there.
Once again, to ask a question, you need to press 0 followed by 1.
Sorry?
They need to press 0 followed by 1.
No. Haven't got 0.
Your first question will come from Grant Swanepoel from invested. Please go ahead.
Hello, Grant.
Are we online?
You are.
You are.
Morning, guys. Just one question. Scared the bejesus out of me when you start talking about more renewable options to build. If the Rankins aren't, if you guys don't manage to keep the Rankins around,
Hey, hold
when
on.
would you consider pulling the trigger on one of your own renewable options?
Hold on, Grant. We said we had options. Didn't say wind farms. Didn't say renewable options. We said options.
Okay.
So that might relate to how we use water.
Excellent. And
Yeah.
could you just give some sort of
I
idea
knew you
of
wouldn't want us
what,
to spend any money.
you ever did do a renewable option, what the current long-run marginal cost is on your wind options?
We've got stuff that sits anywhere between $70 and sort of 95. Depends on what the exchange rate is on the day,
Yeah.
of course.
Thanks, Paul.
I don't think anybody's going to build too much, Grant,
There appears to be no further question.
before there's a bit more certainty around where TY sits. Unless, of course, the Rankins go. Any other questions?
And your next question will come from the line of Peter Hudson from Macquarie. Please go ahead.
Peter Hudson.
Hey, hi guys. I just wondered if you could give us an update on your energy yields out of your wind assets in both Australia and New Zealand. You seem to be getting a bit more juice out of the New Zealand assets. Just wanted to confirm that that's a trend that we should be perhaps factoring into our models. And also, obviously, on Australia, we've had one player downgrade its energy yields recently. I just wondered if you can update us on your thinking with regards to those assets.
Yeah, well, I think in the presentation, Huddy, we said that it was very good to see that Mill Creek over the last year has beaten its wind yield against the business case, which is good. I think to say you would change your assumptions across our New Zealand fleet, I mean, that would be a little bit too bullish, I would say.
Yeah, I'd agree with that.
I mean, I think you should be sort of leaving that alone. And in terms of Australia,
Too early.
I think it's too early to really tell.
We've got nothing at the moment that indicates some massive gap or massive increase. So, and you have to really see a number of years before you start to bring conclusions to bear on this sort of stuff.
I mean, I think that the standout story in Australia at the moment, Huddy, is the fact that, I mean, prices are so high. I mean, Paul alluded to the fact that we have, following our policy, I mean, hedged LGCs, but with the black price and, the current LGC price, I mean, all up prices in Australia are, around about $120. So you've got that against seeing some renewable options, or a lot of wind options out there at 80 sort of dollars in Australia, $85, and nobody's building anything.
Okay, thanks guys.
Any other questions?
And your next question will come from Wade Gardner from UBS. Hello.
Yeah, hi Wade.
Hi. Just following on from that comments about options, if Rankine units get closed. In terms of accessing a greater range in Lake Pukaki, can you just give a bit of colour around the cost to do that? And I guess, how much work you've done in terms of the feasibility of it?
Look, we're looking at a number of options that, I mean, it would be unwise of us to sort of fully detail here, but as part of looking at those options, yes, we have looked at obviously our situation with water in the south. And I don't think I really want to say too much more than that, but all I will say is we are looking at more than one option in that regard. And just remember, if you read my speech notes, when I talk about other options with third parties, I talk about that in the plural, so we're not just talking to Genesis. Any other questions?
There are no further questions on the phone line.
Excellent. Well, can I just thank you all very much for coming, and encourage you to buy some Meridian bonds. Better than having money in the bank. All right, thank you very much.
There is some...